This episode is going to look at the closing entries required at the end of each accounting period. At the end of every accounting period, after financial statements have been prepared, we have to close out the temporary accounts. Temporary accounts are the accounts that accumulate transactions that are reported only within that current period. Those temporary accounts are revenues, expenses, and dividends. These account balances are closed, which really means to transfer their balances to retained earnings at the end of the current accounting period to get these accounts cleaned out so they have nothing in them and they are ready for transactions of the next accounting period. We only close out revenues, expenses, and dividends. All of the other accounts are what we call permanent accounts: assets, liabilities, common stock, and retained earnings. These accounts permanently hold on to the transactions recorded within them. We do not close out the permanent accounts. The closing of the temporary accounts is a 4-step process. We have 4 closing entries to prepare. The first closing entry closes revenue accounts. The second closing entry closes expense accounts. The third closing entry will close an expense and revenue summary account, which we call the income summary account. And the fourth closing entry is to close dividends. So let's look at the first closing entry. We're going to assume that the above account balances are existing at the end of the accounting period. So financial statements have been prepared, and we are now getting ready to start recording transactions for the new accounting period. But before we can do so, we need to take these balances that reflect transactions from the accounting period that just ended and close them. The first closing entry is to close out the balance in each revenue account. In the general ledger, we see that all revenue accounts have credit balances. So our first closing entry will be to get rid of the credit balance in each revenue account. To get rid of a credit balance, we need to debit it. So our first closing entry is to debit each revenue account for whatever its balance is. So here we need to debit revenue for $25,000. And we will transfer that $25,000 balance to this account called Income Summary. After that closing entry is posted, the revenue account is closed. There is nothing recorded in it, and all other revenues are temporarily recorded into Income Summary. Our second closing entry will be to close out the expense accounts. If we go to the general ledger, we will see that the expense account has a debit balance of $18,100. To clear out that debit balance of $18,100, we need to credit that account for its balance of $18,100. We will transfer that $18,100 into the income summary account by debiting it. So the journal entry is a debit to income summary, credit to each expense account for its balance. What we have now done is zeroed out the expense account. Its balance is 0. It is closed. All of the expenses are now temporarily recorded in income summary. Our third closing entry is to then take the balance in income summary. If we have credited income summary for revenues and debited it for expenses, we are going to be left with a balance of $6,900 credit because the revenues were greater than the expenses. So now we can prepare the closing entry to clear out that credit balance out of income summary. To get rid of that credit balance, we are going to debit it, and we will transfer the amount of net income to retained earnings with a credit, thus increasing retained earnings by the amount of net income for the period, and income summary, which was just temporarily used during the closing process, That is now 0. The fourth and final closing entry is to close out our last temporary account, which is dividends. In the general ledger, we'll see that dividends is sitting with a debit balance of $2,000. To close out that debit balance, we are going to credit that account, and we are going to transfer it directly to retained earnings. Revenues and expenses were initially closed to income summary, and then income summary was closed to retained earnings. But dividends are closed directly to retained earnings. Thus, after the 4 closing entries, all revenue, expense, and dividend account balances will have been transferred to retained earnings. And that retained earnings ending balance reflects the final amount of retained earnings as of the end of the year. The final step would be to prepare a post-closing trial balance, which is prepared after closing entries have been posted to the general ledger. This post-closing trial balance, listing all account balances to ensure debit balances equal credit balances, ensures that temporary accounts have been closed, and the only accounts in this trial balance will be the permanent accounts, the assets, liabilities, and equity accounts. That is because all of the temporary accounts, revenues, expenses, and dividends will all be 0. They have nothing recorded in them, and they will be ready to start tracking those transactions in the new accounting period.